China, widely regarded as the world's largest car market, has often been portrayed as poised to dominate the EV industry. However, this narrative is far from accurate. The reality is that numerous EV companies face financial struggles, with over 400 of them having already gone into liquidation. As a result, thousands of abandoned electric cars can be found across the country, representing the challenges faced by the Chinese EV industry. Join us as we delve into the details of the world's largest EV market and uncover the reasons behind the staggering 90% bankruptcy rate among Chinese EV manufacturers. China's early adoption of the EV trend became evident in 2018 when the Wall Street Journal reported a staggering 487 operational EV makers in the country. This significant figure can be attributed to the clear message conveyed by the national government, which emphasized China's ambition to lead in electric vehicle technology. Local governments also eagerly embraced this opportunity and actively invested in these smaller companies. In 2010, China's strategic vision recognized new energy vehicles, NEVs, as a crucial sector within the umbrella of strategic emerging industries. NEVs encompassed pure electric, hybrid, plug-in hybrid, and fuel cell electric vehicles. Over time, the focus shifted primarily towards fully electric cars. To demonstrate support, the Chinese government implemented a range of measures, including generous subsidies, tax breaks, procurement contracts, and policy incentives. This favorable environment fostered the growth of domestic EV brands, which dedicated themselves to refining technologies that catered to the practical needs of Chinese consumers. The efforts also cultivated a significant cohort of young car buyers who increasingly favored electric vehicles. Since as early as 2001, the Chinese government has been investing in EV-related technologies, highlighting their importance in the country's 5-year plan, the highest-level economic blueprint. In 2007, the EV industry received a significant boost with the appointment of Huan Gang as China's Minister of Science and Technology. Huan, an accomplished automotive engineer with experience at Audi in Germany, had already shown a keen interest in EVs. Notably, he personally tested Tesla's first EV model, the Roadster, shortly after its release in 2008. Many credit Huan with the pivotal decision to wholeheartedly embrace electric vehicles at a national level. However, despite the promising start of these 487 companies, only one of them currently operates profitably. Recent statistics indicate that merely 40 companies remain operational, while the remaining 447 have faced bankruptcy. Among the surviving companies, only BYD is currently generating profits from EV sales. This doesn't imply that the others won't succeed, as the challenges of achieving profitability in the EV sales market are widely recognized. Presently, Tesla and BYD stand out as the exceptions, being the sole companies that have achieved profitability in EV sales. However, when comparing the operating profit margins of these Chinese companies to Tesla, there is a significant disparity ranging from 14 to 74 percentage points. Despite BYD's impressive sales growth, the company struggles with modest profit margins, trailing far behind Tesla. These numbers highlight BYD's long journey ahead in terms of cash flow, with a substantial difference of as much as 16 to 20 billion US dollars compared to Tesla. Numerous Chinese companies have faced substantial disruptions in their capital chains, particularly in the current year. Emerging car manufacturers operating in the second, third, and fourth tiers, such as Highways, Leapmotor, Weltmeister, Skywell, Hosan, SciTech, and Future Mobility, encounter significant challenges in sustaining operations and competing in the market. Insufficient capital remains a critical factor contributing to these difficulties. Despite successfully establishing production bases and acquiring vehicle manufacturing qualifications, many of these companies face limitations due to inadequate funds for product development and expansion. Insufficient capital can hinder a company's ability to uphold high product quality standards and competitiveness, resulting in decreased sales and increased financial losses. Companies like Highways, Weltmeister, and SciTech have experienced poor sales due to issues surrounding product quality and competitiveness. These problems significantly impact their financial performance, leading to losses and jeopardizing long-term sustainability. Although SciTech secured a Series A funding of $500 million in 2021, these capital injections may not be sufficient, given the fiercely competitive and capital-intensive nature of the electric vehicle industry today. Additionally, the transition from manufacturing small electric vehicles to high-end models presents another significant challenge for small companies within the Chinese EV industry. This transition often necessitates substantial capital investment to develop advanced technologies, expand production capabilities, and establish a brand presence in the high-end market segment. While some companies attempted this transition, the sales performance of their newly introduced high-end models fell short of expectations, resulting in significant financial losses. Leapmotor and Skywell Auto are examples of companies facing this issue. Despite their plans to capture a larger market share by targeting the high-end segment, the sales performance of their high-end electric vehicles failed to meet anticipated levels. Limited vehicle deliveries pose another challenge for certain companies within the Chinese EV industry. Hosan Auto, for instance, has encountered difficulties in delivering vehicles to customers, with only 900 units successfully delivered thus far. In an EV market where monthly delivery volumes often reach tens of thousands, such low delivery figures can undermine consumer confidence in the company's ability to meet customer demand effectively. Consequently, this can lead to reduced market presence, diminished brand reputation, and difficulties in attracting new customers. Limited vehicle deliveries can arise due to multiple factors, such as production restrictions, supply chain difficulties, and logistical hurdles. Insufficient production capacity, manufacturing bottlenecks, and inadequate distribution networks all contribute to the restricted delivery capability. Furthermore, established car manufacturers in China, like Great Wall Motors, Geely Auto, and GAC Group, have witnessed substantial growth in their sales of new energy vehicles. This trend not only reflects the shift in consumer preferences towards electric vehicles, but also increases the pressure on emerging companies in the Chinese EV market. Despite the challenges faced by some Chinese EV automakers, the overall growth trajectory of the Chinese automotive industry is expected to remain strong in the coming years. Several factors contribute to this positive outlook, including robust domestic demand, technological advancements, and an expanding global market share. China's extensive domestic market, driven by a large population and rising disposable income, continues to fuel the demand for vehicles as consumers prioritize environmental consciousness and seek sustainable transportation options. The demand for new energy vehicles, including electric vehicles, is projected to witness significant growth. China's commitment to research and development will significantly impact the automotive industry, encompassing electric vehicles and autonomous driving technologies. With an estimated R&D expenditure of 2.8% of GDP by 2025, a considerable portion of this investment will likely be directed towards advancements in the automotive sector. This increased focus on R&D will contribute to the development of state-of-the-art technologies, further solidifying China's global leadership in electric vehicles and autonomous driving. In the Middle East, Chinese automakers are strategically positioning themselves to expand their presence and increase their market share. The region's automotive market is projected to grow at a compound annual rate of 5.2% from 2021 to 2026, according to the latest automotive report. This growth presents significant opportunities for Chinese car manufacturers to bolster their sales and influence in the Middle East. As the region embraces the transition to electric vehicles and renewable energy, Chinese automakers with expertise in EV technology are poised to reap substantial benefits. Leveraging their experience in manufacturing electric vehicles and advancements in battery technology, Chinese automakers are well-placed to cater to the evolving preferences of Middle Eastern consumers. We would love to hear your thoughts on this news. Please share your opinions in the comments section below.